Okay, good morning, everyone. Welcome to Genesis 2024. It's been a bit of a topsy-turvy world, I guess, of late, and certainly this year has been full of uncertainty and things we probably didn't expect. Some we may have expected but didn't want to happen. But you know, we'll hear more of those during the day, I'm sure. And kind of odd, and so I've been involved with Genesis now for 24 years. And it struck me this is the first time I've ever done the opening remarks to welcome people, which is quite bizarre in some ways. So I feel like I've known many of you doing this for almost as long as me, I guess, which is nice to see some familiar faces and new faces. And it's been a quite an exciting year for One Nucleus for all sorts of reasons, as much as we've had uncertainties in the sector and challenges. And some of that is down to some new things we've been doing, which I'll briefly share with you, because I think it's always nice to put pretty pictures up. And but things like the training sat now, we have so many of our companies saying, where can we find training in specific areas? And it's not an obvious place to go a lot of times. So we're gradually building this repository and just links in all the stuff we do. We do our own training courses, but this is more where you want to find other things. And then last year, we've launched annual awards, which is the first time we've done those as One Nucleus. So thanks to everyone who engaged in that and supported it, and we'll be back again next spring with that dinner. And the Boston Boot Camp we launched last year was the first time we'd done anything like that, frankly. It's been quite a steep learning curve for us internally on those things because we didn't know how it's going to play out either. But if you don't try these things, you never really know where it's going to go. I kind of feel we're lucky as One Nucleus to work in such an innovative industry. And if we don't innovate as the membership groups to deliver something new, we're the weak link in the chain. I don't like that idea. So not everything will work, but if everything worked, I don't think you're being innovative enough. You have to take some risks. So those are some key things. And of course, our two flagship events here today, and then on Helix in the summer. And even Genesis has changed a little bit this year and evolved because we now have a collaboration with Resi London, which is across the road at Cavendish Square. 2-minute walk, but it's much more of a full-on investor pitching and partnering day, which we don't really do as Genesis. This is our ecosystem coming together to say, where are we going? That's kind of the pitching. Is it like, what am I doing tomorrow? I need money mostly. So again, that's just, we thought we wanted to bring something new into the ecosystem, and Resi offered that. So I'm delighted we've been working with the London Life Science Nation group to bring that in from the US. And from afternoon coffee onwards, some of the Resi delegates will be free to come over here and meet more of us. So I hope you'll enjoy meeting some even newer faces. We're lucky as well to be supported around Genesis by a communications advisory panel that supports Natalie and our team on the marketing. And you'll come across a number that you haven't already. They're undertaking a small survey for us to find out how we can engage better with our audience and how people are interacting with different routes of social media and what actions they take, what do they want to hear. So we'll look forward to developing that. And I don't think that's, again, something that's just a One Nucleus and Genesis thing. I think as a sector, we can always learn to how we do this better. You know, it's not just our events, it's not just the networks and connections. It's if we're all starting to get better at these things, then they will be more productive rather than just more activity. So that's keeps changing, and we go with the topsy-turvy bit. And speaking with that, I thought I might start upside down a little bit for conferences, maybe. Because we always get to the end of the day and then we do all the thanks. And then it's like, oh, I don't know who that was, because they've gone by now. So thanks from my side to our sponsors, the speakers who are giving up their time to do this, the exhibitors, and you as delegates, because we can't do any of it without any of those stakeholders. So thank you for making this possible. I guess then as well, it's thanks to our board, and I'll touch on that again in a moment about some changes there too. But also to this motley crew. This is the One Nucleus team that sits behind what we do all year, what we do today. So and they work really hard so I can stand here and do this bit. So I'm doing my best not to let them down now, which is, but the number of them are here today, so do say hi to them. And anything you want to feed back to One Nucleus, feel free to do that as you go along. So thanks to them. And then I mentioned changes on the board. John Green outstandingly served One Nucleus, IRBI before it, and the life science sector generally. John stepped down as chair in the middle of the year. But John couldn't be here today, but I want to thank him for his contribution to what he's helped us do. And Prashant Shah is our new chair. So dawn of a new era, probably, Prashant will see it as, and a sign of evolution. And these things happen. Prashant equally can't be here for this morning, but he will be here this afternoon to say a few words to the delegates here from his new chair's position. So we'll look at Prashant later. And that's not much more from me, really. So I'm looking forward to a great program. Thanks to all the speakers who've given up their time to prep for it, to be on the panels. And I think beyond that, I'm around all day, obviously, so is the team. Like I say, come and talk to us if there's more you want to know about us. I'm quite happily wax lyrical about One Nucleus for a long time. It's a great passion. But apart from that, I know, like, everybody tells me cash is king. So what's happening in the markets today? It may not be the same as tomorrow. But at least there's some individuals I'm now delighted to welcome to the stage in shape of Walker-Arnott, and then followed by David Stubbs from Charles Stanley and Raymond James, who will come and tell us about some of the macro and life science related funding going on in the markets. So hope we'll do well.
Straighten that up for the tall people. Thank you, Tony. Thank you for the introduction. So my name's Will Walker-Arnott. I'm a Director of Private Clients at Charles Stanley. We are part of the Raymond James family. And so this opening section, which is going to be looking at financial markets in 2025, is going to be divided into two halves. I'm going to look more broadly at what's going on in the macroeconomic environment. I'll only be sort of 5-7 minutes, because where you really want to focus is on my colleague, David Stubbs, who's head of investment banking in Europe for the healthcare team. He is going to focus on what's actually specifically going on in the life science and biotech arena. So on we go. If I turn on to the first slide here, you might not be able to see all the detail on these slides, so I'll try and paint the picture with words. But going back 18 months ago, things were looking a bit gloomy, to be honest. You'll remember it was a period where inflation was at a very high level, and we had just been through probably the most dramatic increase in interest rates for a generation. And at that point, everyone was saying that a deep recession was likely, and financial markets were even indicating that. But as we look out to 2025, I think there's a lot of optimism. And if you look at the blue bars, this is what we're expecting in terms of GDP growth in 2025. You can see actually it's positive, which is the first important thing to say. Now, there is disparity there. And you can see that in the UK, Europe, Japan, it's pretty anemic growth we're expecting. We've got particular reasons why that is. I mean, you could say that in the UK, we've probably had a bit of an inauspicious start from the Labour government. Europe, there's political crisis in France and Germany. And China, actually, you can see that growth is tailing off. Now, they've had issues in the property sector. There's even a threat of a balance sheet recession. So there are concerns over there. But the exception, and it continues to be the exception, is the US. And you can see there, the US is going to, in our minds, continue to power ahead in 2025. And one of the reasons behind that, I suppose, is that the US really does remain the engine room of global growth and continues to hum. Here we look at employment data in the US, and if we look on the right-hand chart, you can see that the US economy continues to create jobs, and looking at the purple sort of line, which is the average over that 2-year period, is still creating about 100,000 jobs a month, which is strong by any stretch. And unemployment remains at low levels. So we've got a US market where employment is strong, and we're still seeing productivity increases, which is the envy of the world, to be frank. Inflation was the thing which really dominated people's minds over the course of 2022 and 2023. And for an asset class which is long duration, like life sciences, interest rate projections are absolutely key. This is quite busy, but effectively we've divided the world into regions. If it's red, it means that inflation is above central bank targets of 2%. And you can see back in 2022, we were having sort of double-digit rates of inflation in the Eurozone and the UK. Thankfully, as we come to sort of 2024, you can see nice blue segments, which is where actually inflation has dropped below the central bank target, which is really encouraging. So I think central banks have actually done something quite remarkable, really. They've walked the tightrope. they haven't crashed the economy by rising interest rates and managed to get inflation down to a manageable level. Now, we have to be mindful of the impact of Trump 2.0 could have inflationary impacts. So we're thinking things like, obviously, tariffs. We're thinking how he's going to tackle immigration. We're thinking about things like tax cuts. But for the moment, inflation is coming down. It always seems that the last mile is the most difficult. And so we may well see inflation sort of more gradual falls over the course of 2025. But the trajectory is clear. Inflation is coming down, and that is a good thing. What does that mean for interest rates? Well, we are expecting interest rates to continue to fall in 2025. So over the next year in the US, we would anticipate 3 further rate cuts, possibly starting in December of this year. At the moment, the market is expecting a 60% likelihood of a next rate cut in the US in December. Now, interest rate expectations have moved quite a lot over the last 12 months, up and down. Before Trump came into power, we were probably expecting about 6 rate cuts over the coming 12 months. So rate expectations have been dialed back, but the good news is that the trajectory is still downwards, which is positive, particularly for life sciences. Now, if we look at what's been going on in the equity markets, it's been a pretty stellar year, 2024, if we're looking across the indices. If we look at the S&P 500, up 26% year to date. NASDAQ up 29%. And you can see that PE ratios, looking at the multiples, are way above the average. Now, we have to recognize a lot of that is concentrated in the sort of Magnificent Seven, the big tech behemoths of the US world. But nevertheless, we've been through a very, very pronounced equity market rally. And there is a lot of regional divergence. So looking on the left chart here, the green line is the average multiple of PE ratios, and the sort of the blue diamond is where we currently sit. And actually, if you look across the world, in Europe, UK, China, they're all depressed share levels. It's the US where we're seeing those heightened valuations. Now, we think actually that this period of US exceptionalism will continue in 2025. And the reason why we think that the US is likely to continue to outperform other regions, I suppose, is threefold. You've got these huge, big, great tech behemoths which are investing huge amounts of money in research and development. And so productivity improvements are likely to continue. Trump, in the short term, is providing a sugar rush to the US economy in the shape of deregulation and also tax cuts. And finally, we have to remember that they are very fortunate in the US by their geographic position, and they are going to benefit from the fact that they're shielded from geopolitics. They also are completely self-sufficient in oil and gas, which is a huge benefit to them. So we are predicting that US exceptionalism in the US will continue into 2025. So, conscious of time and the fact that we want to just hand over to David. So putting this all together, what does this look like for the macroeconomic outlook for 2025? So we still think the US equity market has legs. So far, it's been very concentrated in the big tech behemoths, but more recently, we've seen a broadening out of the rally. So areas like financial, smaller companies are coming to the party. So we think that there's still further to go in the US equity markets. We think there's going to be a gradual reduction of interest rates over the course of 2025, but that is positive. But as always, midterm, there are dangers lurking out there, and we can't be complacent. So inflation, we've really got to keep an eye on that. Will there be a second act to the inflation story? Is some of Trump's mercantilist policies going to really get inflation alight again? We'll be keeping an eye on that. Geopolitics, there are 3 key regions out there we've got to keep an eye on. Obviously Ukraine, Middle East, but also Taiwan. How's that going to play out? So we look at what's going on in South Korea as we speak. And then finally, the drama that is Trump Series 2 is going to create some volatility. And I think we've all seen that since Robert Kennedy Jr. was announced as health secretary, the kind of volatility we can see in equity markets. But that's just a broad picture of the macroeconomic outlook. I'm now going to pass over to my colleague, David Stubbs, who's going to focus more tightly on the life science and biotech arena.
Oh,
Well, thank you, Will. As an American, I will stay away from talking about Donald Trump, so we'll start there. But as Will mentioned, I would like to drill down a little bit on to what's going on in the life sciences sector. And since I'm old-fashioned, I have my notes on my chart here, so I'll run through this. You know, as was mentioned earlier, I'm a managing director at Raymond James, and I run the healthcare business at Raymond James in Europe in the investment banking department. So I thought what we would really focus on is, go here, we have a little overrun there, but what I like to focus on here is actually a brief overview of the recent history of what's happened in the life sciences sector. So if we think of what's happened today, let's start with 2020 and 2021. And really, these were the peaks of the life sciences sector, both in biopharma, in addition to diagnostics, medical device, and other of the industries that we care about. And in biopharma, really the run-up, as we saw, was a result of a lot of new therapies coming to fruition. We saw kind of the rise of immunotherapy and these products coming to market. We also saw a lot of advancements in immunology and a lot of other technologies coming to market and creating a lot of excitement. In diagnostics, the peak was largely driven by the massive impact of COVID, right? So we had a lot of companies that were well positioned to take advantage of testing volumes and actually move forward and drive tremendous amount of cash flow in the diagnostic sector to get them to the all-time highs that they experienced in 2021 as related to the cash flow driven by their COVID testing. What I would say is, as we look at then time since 21, things have been a bit murkier. And I always enjoy going to the JP Morgan conference in San Francisco at the beginning of each year because I find that there are all these prognostications that then become more than prognostications, and everyone seems to be saying the same thing by the end of the conference. So I captured a few of these, so I'd like to take a little bit of a walk back in time here. So if we look back at 2022, I think the theme that we saw was something like the following. It's hard to see over the horizon, but from here it looks like 2022 will be a tale of 2 years. The first half of the year will be challenging, but we'll see recovery coming in the second half, and I credited an unnamed investment banker with that. Obviously that did not come to fruition, but the optimism continued into 2023. And the theme in 2023 was, this year we're starting to see much more activity in the market. We're seeing a lot of crossovers and a lot of companies looking to get out to the public markets. Well, we didn't see that either, actually, at all in 2023. So in 2024, we all got together and said, okay, we're going to actually really nail it this year. So what do we think is going to happen this year? Well, this year, the backlog is bigger than ever. More companies need capital. The capital's out there, and we're going to see a tremendous amount of capital raised in the public markets. And all we need is just a slight tailwind. So we didn't see much of that either, actually coming to now. Having said that, I think I've just... Second. I just lost my slide. If I can advance on the keyboard, hang on, that will be okay. Yeah, I can. Okay, fine. So, having said that, this is what happened. In reality, it felt like the beginning of the movie John Wick, and I don't know if for those of you who have seen John Wick. At the very beginning of the movie, he takes such a beat down that it looks like he will absolutely never recover. And that's a lot what 2022, 2023, and the first half of 2024 felt like. And you can see that over on the right-hand side. If you look at the slide, this is a absolute falling off of a cliff, right? We had 130 IPOs in 2021. We had 100 in 2020. And then in 2022, 2023, and 24, with notable exceptions, we had very small deal volume. So that was quite a bit, no matter the prognostications, quite a bit of a disastrous time, at least if you look at it from the standpoint of the IPO market. The other thing I'd like to say is that was the IPO market, and we looked specifically at biotech, or healthcare in general, but no sector has actually been immune to the downturn. And as you'll see in the following page, I'll go through that. So IPO activity has faltered across healthcare information technology, it's faltered across diagnostics, it's faltered across medtech and biotech, and you can see this in the trends of each one of these subsectors. They all look about the same, and they've all performed similar to healthcare as a whole. This is also kind of mimicked in the data that we see in the indices. And what we're looking at here is on the left-hand side, we're looking at the biotech market, and this is peak to the end of 2023. So these data might look slightly different, but let me just explain. This is peak to the end of 2023. What you saw during that time was robust performance for a variety of reasons, some of which Will touched on. In the S&P, which was up 21.8%, NASDAQ up 7.3% in recovery from the COVID era, the IBB down 21%, and the XBI down 48%. So you can see biotech relative to the major indices was abysmal performance. Similarly, on the right-hand side, from peak to trough, and these numbers are different, and understand that the peaks came at different times. That's why the different data. But you can see from peak to trough in the diagnostic sector, which followed the biotech sector, you can see that the S&P and the NASDAQ were roughly flat, but the diagnostic sector was down relatively about 27.4%. Also for diagnostics, IPO performance has not helped. This chart is particularly astounding to me because I spent quite a bit of time covering the diagnostic sector. What you'll see is, with one notable exception, every single deal since 2019 is broken. So that is a statistic that I haven't seen over the course of my career. And the average deal that priced an IPO since 2019 to date is down about 70%. So the however and the but here is that life sciences, especially biotech, have always been cyclical. And this is a chart looking at performance over time. And we've seen that in the last 16 years since the financial crisis, you've seen that, that there have been troughs, including in 2013, 2016, 2019, and currently. But we also see is there's always been a recovery. And incidentally, just one data point is, if you look at this chart, is if you look at the index, if you were to buy the life sciences sector effectively in 2008 and hold it to today, you have a 4x return. So over time, this continues to be a very robust industry. However, the peaks and troughs are very severe, as you can see from this page. So as someone well-known around these parts said, if you're going through hell, keep going. And that's where I'd like to turn to in the following data, which will help provide us maybe a little bit better perspective and actually suggest why that's actually a decent policy, especially in the life sciences sector. Turning back to the John Wick metaphor, what I would say here is later in the movie, he famously says, as he returns to strength, people are always asking me if I'm back. I haven't really had an answer yet, but yeah, I'm thinking I'm back. So I think the same can be applied to the life sciences sector. And if you look at some of the indices over on the right-hand side of the chart here, what you'll see is that, you know, the performance, although it's still lagging the greater sectors, and you've seen in Will's comments on the macro sector, you know, you'll note that he referenced the Magnificent Seven. I mean, it's hard to escape the fact that that what I call the outside market, the top market, has been growing rapidly in the U.S. and you've had this great performance. But largely, that's driven by mega cap companies. There are multiple $1 trillion+ market cap companies in the U.S. that are driving that performance. But what you'll see here is, if we look at back to the beginning of 2024, you'll see that although we're still lagging the larger indices, that the life sciences sector, both, and I pulled the diagnostic and the biotech sectors here, are starting to perform. So biotech on both the XBI and the IBB, you'll see are up in the single digits, 24 year to date. And you'll see also the diagnostic sector has returned to flat performance. And so I think the message here is that the hemorrhaging seems to have stopped, at least for now. Following that, if we go back to the slide I showed earlier and we kind of dig into those data that we looked at, you'll see that if we really compare 2019 to 2024 year to date, you know, we're really not that far off. It looks bad in principle, but if you think about where we are, we've done 18 deals to date in terms of the IPO market, which is a good bellwether indicator for how private investors think about investing and so forth. You'll see that we have raised $3.8 billion and 18 transactions have been completed. And that's relative to 2019, where you have $5.3 billion raised in 42 transactions. The message is, this is always what you see when the market comes back. You see bigger deals with higher quality companies. So of course you're going to see lower volumes, but the point is there's still capital out there and the capital is still being deployed. I think one of the frustrations for maybe many people in this room and people in our sector has been that while we have suffered the investment or lack of investment over the last several years, the message has always been there's lots of capital out there, and the reality of it is there is lots of capital out there. It just hasn't been deployed, but we're starting to see that happen a little bit more now in the end of 2024. The other factor I'd like to point to that is relatively positive here is that M&A has always been a backdrop for capital market performance in life sciences. So when you see large transactions and you see successful transactions, that will continue to drive people's interest in the sector, and it drives also investment in both the private and the public sectors. 24 has been a record year for large private transactions, and I want to emphasize that. And you see this in the lower right quadrant of the slide, where you see that there have been 10 transactions, and this was 2024 year to date, which is a record, where private companies have been bought for in excess of $750 million per transaction. So that is a good sign also for the markets to say, hey, we better start paying attention to these companies. If they're getting bought, we'd rather be in these companies before they're bought than read it in the headlines. So that's a very important dynamic. The other thing I'd say on this slide, which I think is very interesting, just as a general comment about the life sciences sector in general, if you look over to the bottom left of the slide, you'll see a statistic that I find rather astounding, which is that just in general, since 2013, there have been 554 transactions that have been at a transaction volume and or amount of capital of $1.5 trillion. So there have been $1.5 trillion of M&A transactions in our life sciences sector since 2013, which is quite frankly staggering. So the overall environment, you have to admit, investors understand they have to be in it. They just continue to play the cyclicality. On the next slide, how does this play out with private transactions? What we're seeing at the end again in 2024 is a bit of a different cycle. So we're starting to see larger deals are coming back. Substantial capital is being deployed at the end of 2024. You could argue that also there's a flight to quality here. So I realize that. However, the data suggests that the median transaction for a Series A is now approaching 70 million. This is all in USD, apologies for that, but 70 million USD for a transaction. And then also for Series B, C, or later, it's approaching about 100 million per transaction. And those numbers, as you can see on a quarter-over-quarter basis, have been increasing steadily throughout 2024. Also, they're still trailing the S&P. If we look at on a last 12 months basis, what you see is that the XBI and the NBI from a biotech perspective are actually really starting to come back. Before we looked at 2024 year to date, but on a trailing 12 months, what you can see is that the S&P 500 is up 32%, but not lagging too far behind, in positive territory now substantially. Looking at the last 12 months, we have the XBI and the IBB respectively up 18% and 12%. So again, in the backdrop for performance, people are not losing money in the public markets on biotech stocks over the course of the last 12 months. In addition to that, if we think about the IVD and LDT diagnostic players, one thing we will see is similarly the multiples have stabilized, and the circle on the chart here is just suggesting that although this isn't necessarily robust performance, we've really kind of returned to pre-COVID levels in the IVD and the diagnostic market. And as a matter of fact, since 2022, we've seen about 11% multiple expansion across the diagnostic sector. So again, a relatively good sign compared to what we've experienced since 2021 in the diagnostic sector. In addition, if we return back to our slide that I showed before, and we add one more data point, and one kind of side note here is that since 2021, there had been exactly 0 diagnostic IPOs, which is kind of unfathomable and I hadn't seen before. Intel Tempus went public in 2024. Tempus is up 50%. It's performing well. It's been an exceptional deal, and it's been kind of a darling of the market. So that is a great data point in itself for the diagnostic sector, and has focused investors to be reminded that there are great companies out there, and if you get behind the right stories, that there is money to be made across the sector. Also, in terms of the private market for diagnostics, the private market is still there, and as I say here in the headline, albeit more selective. So we're not seeing a tremendous amount of deals in the diagnostic private market, but what we are seeing are a number of deals for high quality companies, and the capital is still out there. So I think, the capital is still there. That theme is consistent. We've heard that over the course of the last 3 years, but now we're starting to see capital be deployed more consistently across the subsectors in life sciences. So what does this mean to all of us? And I think what it really means is, though, and we talked a little bit about, and Will did a great job explaining what's going on in the macro environment. Predicting the future is always difficult. We'll see what specifically in the U.S. happens with the new administration. There's a lot of hand-wringing about that. That's understandable. There's a lot of geopolitical issues going on as well. Having said that, though, predicting the macro environment is difficult. Life sciences has always been cyclical, and it's important to remember that. Recent signs are telling us that we're getting set up for overall positive sentiment to return. And though I don't want to be one of those who sits around at JP Morgan this year and says 25 is going to be the year, and I won't do that, I will say that the signs are, at least now, the data is showing us, are pointing in the right direction. And history tells us that although it may not be now, it will be a matter of time and the sector will return. So thank you very much. And